change gears to Bank of Baroda. Sanjiv Chadha, Managing Director of Bank of Baroda, joins us now. Sanjiv, good morning. Thank you for joining us. Loan growth highlight for the quarter gone by. What are the levers that are helping you? Because for the quarter gone by, your loan growth, in a sense, was the high point.
I think, as you mentioned, it is the growth momentum that we seem to have acquired, which really is the highlight for the quarter. If you look at the last few quarters, there was a steady improvement in terms of the credit costs and therefore margins profitability. But what was a bit of a challenge over the last 12 months was that for the corporate segment in particular, you had to choose either growth or margins. We had guided at the beginning of this quarter that we believe that is now changing, and it should be possible to have both margins along with growth. And that is something which I think has worked well. Also, on the retail side, there were certain segments which were doing very well for very many quarters, car loans being a case in point. But home loans, which is 70% of the retail portfolio, that had been a little less than optimal for us. And therefore, home loans growing 15%. And on top of that, car loans growing about 25%, personal loans growing more than 100% has meant that retail growth organically is now 23%. So that's, I think, something which is very important for us. And the other part, of course, is that, as I mentioned, because of the change in the liquidity environment, it is possible to grow corporate and also to have margins. And therefore, we have seen corporate also now growing about 17%. Part of this, of course, is that we had a bit of a rough first quarter last year, but I think the growth momentum that we have seen has been continuing right through the last few quarters. So I think that's a good sign for the bank. So to my mind, in this environment, if you can combine growth along with the reduction in credit costs, that augurs well for the results of the bank.
International advances are up 30%, which comprises or which now account for nearly 17% of the total book. What is the composition here and what are the stress levels like?
So the international book for us is a very healthy source of risk diversification. It also gives the bank a lot of flexibility depending on what is the situation in the domestic market. For instance, as I mentioned earlier, we had a challenge last year in terms of the corporate segment, which is about 50% of the bank's balance sheet. Margins were under pressure, and therefore, as I mentioned, either you grew margins or you had corporate loan growth. But international there gave us a very important flexibility. The margins in the international corporate loan market were significantly better as compared to what those were in India. And therefore, that's what we have been able to capitalize upon. And I think even going ahead, that is the way we see it. Ultimately, the bank is driven by a desire to allocate capital as efficiently as possible. And whenever there are opportunities in international and where you might be able to get better return on capital as compared to at that point in time in India, you would want to exploit that particular opportunity. Also, you talked in terms of asset quality. At the beginning of the year, maybe one and a half years back, there were some challenges in the international book, particularly in the Middle East. But as a general proposition, if you look at a 10-year period, the credit costs in the international are substantially below those in India. Second, if you look at the cost to income ratio, since you largely run a wholesale book, that is about half what you get in India. So I think depending upon the situation, international will be an important avenue for the bank. And given where things are even today, I believe there's still some scope to grow the international book. But again, I would like to emphasize, for us, it is the risk-return equation which is paramount. As long as you get that right, whether it is international or domestic, whatever works better is what we do.
Right. Sanjiv, your operating profit and cost-to-income ratios are up, but that's largely because income also has come down. Where do you see that normalizing?
So last year, there was a change in the regulatory guidelines, which said that any mark-to-market gains or losses now need to be above the provision line, right? And so therefore, last year, because of the fact that interest rates were declining, there were significant mark-to-market gains which were there. There were also treasury profits which were booked. Now, it is part of the normal interest rate cycle that when the economy improves, or when again rates need to be increased to make sure that inflation is neutralized, you will find that you will get better margins on your loan book, and the treasury will correspondingly suffer. Secondly, what we saw over the last quarter was that what is normally a normalization of rates that happens over a year got compressed very substantially, at least in terms of 10-year rates in the last quarter. They were up about 60, 70 basis points as compared to 5, 10, 15 basis points movement that you would normally expect. So therefore, there was again a mark-to-market loss which was there in the bank's books. But the fact is that, again, as a general proposition, when rates increase, it is indicative of the fact that the credit environment is improving, and therefore we have seen more than compensating reduction in credit costs, which is why you find that the bank's net profit on balance has gone up by 79%. Going ahead, I would believe that the benefits of credit costs coming down are likely to persist. But since most of the impact of rate increase has got concentrated in a single quarter, going ahead, we might find that the impact at the operating profit level will also moderate. So to my mind, this was more, again, you might say, one-off on account of the fact that there was a sharp increase in interest rates that happened and impacted the treasury book.
Right. So what is your recovery guidance for FY23 then?
So I think we have been guiding that from our perspective, the improvement in the corporate credit cycle is the most important piece for us. That is something which is continuing. It is being reflected in the lower slippages as well as lower credit costs. And the improvement in the corporate credit cycle will outweigh other challenges which might be there. For instance, MSMEs, there is a little bit of a challenge. But given the fact that the corporate book is by far the largest piece, that will outweigh that. So I would believe that the kind of results that we have had last few quarters and in this quarter, I think that momentum is likely to be sustained.
Okay, Mr. Chadha, we're going to leave it at that. Thank you so much for joining us here on the show with the